Let's welcome in our next guest, David Struczewski, CEO, Sound Planning Group. Thanks so much for being here. So right here as we're wrapping up the first half of the year, the worst first half of the year since 1970. Your thoughts?
Well, you just nailed it right there. Since January through May this year, we've lost 35 trillion of global equity or value. That's 14% of our entire value in the world. To put in perspective, 2018, we lost 18% in 2008 from peak to trough. So the average consumer right now today is looking at this thing and saying, oh my goodness, where are we now and what is up next? When we look at oil, when we look at what's going on in the G7, Germany is now firing up coal plants again. That's an interesting idea. We've got our president running around the world right now looking for people who have oil. And we find ourselves kind of in an interesting moment with more oil than anyone in history. And the ability to do it cleaner and safer than anyone else. So we are in a very interesting time frame for sure. But as we're talking about stocks right now, my big thought on that is that analysts that have been looking at our future, it's very difficult for them to predict, up front. But when an analyst has so many crosswinds going on, whether it's Europe, it's oil prices, it's unemployment maybe that might be starting, we find ourselves in this really, really, really unique moment. And we begin to identify, okay, so as the consumer, as someone, what can we do today? And so a lot of families that we're talking to right now, our big thought to them is prepare. Preparation is the thing that we need to be doing right now. And so, yeah, there's some great names out there. There's some names that are really tempting because they're on sale. Facebook's down 50%, Netflix down 70%. Microsoft has real earnings and has actually outperformed most of FANG. There's really good options out there. But the consumer right now is looking at the fuel pump, they're looking at the grocery store, and they're running out of options.
Yeah. So are those some of the names that you've been recommending to folks, Meta and Microsoft, and what else?
Yeah, I mean, we think that growth can come back into flow right now. Now, there are some challenges with that. The energy sector is also one that, of course, I don't think that that's going anywhere right now. And I'm bullish on U.S. oil if we can get back to doing some of that. Healthcare is another one that tends to do really well no matter what. And we have an aging population right now. So more use tends to be a little bit better. So that might be an okay staple to be able to have in there.
That's interesting. So as you see a lot of these names on the move, I mean, I know you noted so many different things from CVS to Nike to airlines and Tesla and Bed Bath & Beyond and McCormick and Carnival. Are any of these jumping out other than reading the headlines like, I see what's going on too? Do any of them seem like winners or clear losers where you would tell investors, hey, you might want to consider this or its sector or stay away from that because?
I mean, it does come down to the individual names. And again, they flow in and out of strength. So right now, with so many variables up in the air, it's difficult to say these are the names. But yeah, we can see a lot of these names right now. And I think people should just look at what are they normally consuming. It tends to be that where demand will still sustain, that the price will continue to at least stay, if not go up. So there's a lot of those things that people might be actually taking as an evaluation in their own lives. And I'll be honest with you, it's kind of a crapshoot right now. I could tell you value's amazing. I could tell you growth's amazing. I could make a case for everything and then also nothing at the same time. And so with that being said, it's a big challenge for the average person to find it. I'm thinking take half positions in things right now if you're totally exposed. That's what I've really been trying to communicate. I want people to be able to be deployed as we get an oversold position in place, and then we can really find some names that are really singing to us. So we can talk about it, but I'm going to say that until they really start singing loud, that people should be a little bit more cautious right now, especially if they're entering or nearing retirement.
Right, and at this point, you're saying we are in a recession, and while some may not be acknowledging it, you're seeing indicators that tell you, yes, we are, and inflation's still extremely high. What do you foresee going forward based on what you're seeing now?
Well, clearly, Powell has noted that he's going to be raising rates at a very high clip. They have essentially gone down to a single mandate, at least based on the notes that I'm reading and his sentiment. So unemployment's no longer a factor that he's really wanting to consider. It's just getting inflation under control. So I'm expecting the Fed's going to come out strong. I'm very, very, very concerned about real estate because of the average consumer. Each time rates go up by 1%, we end up losing 10% of our buying power. So when we look at it like that, it takes 30% more buying power today to purchase the same value of home. The same home might just be valued less now. What are we going to see here? Third, fourth quarter, I think that there's a lot of volatility. I think that we are looking at a recession right now. And, consumer sentiment tends to be that leading indicator of how does everyone feel about things. Well, I came out last Friday, and it's at record lows right now. So I think the consumer's feeling the negative. We just had GDP come in for sure negative last quarter. So I don't know what would have changed between then and now that would put us in a different spot.
Yeah, and you noted Jamie Dimon's quote about the hurricane that is coming, and the $60 billion in new credit card debt was something that caught your eye, right?
Exactly. And it is a hurricane. The average consumer right now, this last month, yes, went up $60 billion in credit card debt. We are in a very different moment in our history. So I think that we're switching from a growth side economy. And when we only had to bring top line up in order to be valued more, I think that that's changing. And I believe that we're going to have to get more into some fundamentals. And that's really important as we begin to understand that when moments of hurricanes show up, and by the way, those are forecasted things that begin to come, I think that we should get nervous. I mean, the Titanic, by the way, thought it could not sink. It saw many icebergs along the way. It just did not pay attention. I think there's a lot of things that we should be paying attention to. I'm not saying the whole thing's going down. In fact, my vote is it goes up. The reality is what goes up does come down, and it's healthy for us to understand that. We just have some extreme shakeout, potentially really high volatility, maybe even deflation by the end of the year. That was something new that Powell was saying as well. So this is a very, very, very interesting time to be alive, to be paying attention, not a time to be going to sleep on your portfolio, what you're doing, though.
Right. Yeah, good point. Dave Strzeżewski, thank you so much. CEO, Sound Planning Group. Thank you.